Hazard. A hazard is a specific condition that increases the probability or likelihood that a loss will occur from a peril. There are three types of hazards: physical, moral, and morale. Physical hazard. A physical condition that increases the probability of loss, including the use, condition, or occupancy of property. Physical hazards may often be seen, heard, felt, tasted, or smelled. Examples: flammable material stored near a furnace, or an icy sidewalk. Moral hazard. Dishonest tendencies that increase the probability of a loss, including certain characteristics and behaviors of people. Moral hazards are most closely related to some form of lying, cheating, or stealing. Moral hazards are intentional, so these losses are not covered. Examples: an insured burns down their own house or fakes an injury to collect the insurance payout. Morale hazard. An attitude of indifference toward the risk of loss that increases the probability of a loss occurring. Example: the driver of a car stops at a convenience store to pick up a few items and leaves the car unlocked with the key in the ignition. This action increases the probability that the car may be stolen. Methods of managing risk. Managing risk involves analyzing exposures that create risk and designing programs to minimize the possibility or degree of a loss. While there are multiple ways to manage risk, it cannot be completely eliminated. The most common methods of risk management are sharing, transfer, avoidance, reduction, and retention. Sharing. Risk sharing means distributing or pooling a risk among several risk takers with similar loss exposures who agree to cover each other for their losses. Risk sharing reduces the severity of the loss for any one party. Transfer. Risk transfer involves shifting a risk to another party. Obtaining an insurance policy, the most common means of managing risk, is an example of risk transfer because the policy makes the insurer responsible for paying covered losses. Avoidance. Risk avoidance is the elimination of risk by not participating in activities that involve a chance of loss. Never operating a motor vehicle or not owning a car eliminates the risk of being at fault for an auto accident, but avoiding risks may also eliminate the possibility of enjoying life's advantages. Avoidance is not always an effective method of managing risk, in which case other methods must be used. Reduction. Risk reduction involves minimizing the risks we cannot completely avoid. For example, installing fire sprinklers may reduce damage in the event of a fire. Reduction is usually not a complete solution to most risks, however, since it cannot completely account for the element of chance. Retention. Risk retention means maintaining responsibility for a loss, like with self-insurance, whereby an organization sets aside funds to pay potential losses. Self-insurance relieves the insured from paying insurance premiums or qualifying for a policy, but it can result in tremendous financial loss when it comes to risks involving bodily injury, property damage, and liability claims and any subsequent lawsuits. Generally, this method is used by those financially secure enough to withstand significant economic hardship. On a smaller scale, most insureds retain a portion of a risk within an insurance policy in the form of deductibles.